Navitas Semiconductor closed its last regular trading session on May 20, 2026, at an exact price of $22.99 per share, marking a massive single-day surge of 18.32% on an explosive trading volume of over 37 million shares. When the market is closed, it is critical to look at the exact figures left behind, and this closing level represents an absolute historic high watermark for the stock, defying a lot of the older cautious sentiment that hovered around this small-cap semiconductor play just a few months ago. Right now, as the market rests before the next opening bell, this massive intraday move from a low of $19.95 to a peak of $23.37 has caught the entire chip sector off guard. The sudden velocity of this move instantly exceeds the expectations of mainstream market participants who viewed this stock as a highly speculative, cash-burning enterprise tethered to standard consumer electronics. While the common narrative was that specialized material chips would take years to find a profitable foothold, the reality playing out on individual brokerage feeds shows institutional volume aggressively moving in to capture what looks like a massive fundamental bottleneck shift in the wider microchip ecosystem. The common ground among most retail market participants using basic investing sites or the standard Robinhood app was that small-scale component suppliers were trapped under the shadow of larger giants. Many believed that if you wanted real exposure to next-generation power systems, you had to strictly stick to major names like Nvidia stock or wait for massive consumer players like Apple stock to dictate order volumes. Navitas was broadly filed away as a high-risk gamble that would constantly struggle with production yields and client retention. However, challenging that assumption with a deeper look at the recent order structures reveals a completely different situation. The expectation was slow, grinding growth punctuated by heavy losses, but the reality is that major high-power computing infrastructure, electric vehicle architectures, and advanced mobile power platforms are running into severe physical limitations with traditional silicon components. By moving aggressively past those physical barriers, this smaller firm has positioned itself where large-scale tech companies are forced to look at alternative material options. This structural reality completely shatters the legacy thesis and explains why the trading volume suddenly spiked to many multiples of its historical average. When analyzing the recent stock movement, the sheer scale of the volatility over the past few weeks becomes the central focus of the puzzle. Just days prior to this massive $22.99 close, the stock was enduring sharp downward swings, dipping down to the $19.43 level and experiencing heavy selling pressure during early May. This massive tug-of-war in the daily swings highlights a fierce battle between short sellers who have historically held a significant percentage of the float and aggressive buyers who are looking to spark a classic short swings. When you track the numbers on modern digital infrastructure like the Interactive Brokers trading platform or look at internal asset flow via the Robinhood app, the data shows that short interest had reached a critical mass. When a small-cap entity suddenly drops a better-than-expected data point or secures a key supply agreement, those short positions are forced to cover simultaneously, creating a cascading upward spiral. This is exactly what the market witnessed during this recent 18% daily drop, where the trading volume did not just tick upward, it completely overwhelmed the ask side of the ledger, forcing institutional desk algorithms to chase the price higher into the close. Understanding how institutional activity behaves in situations like this requires moving past standard retail perspectives. Big market participants utilizing sophisticated setups like the Interactive Brokers platform or executing large-scale allocations through Fidelity Wealth Management do not buy into an 18% rally on a whim. They look at sequential revenue adjustments, and the most recent quarterly report showed a crucial 5% beat on the top line, bringing in over $8.5 million for the quarter. Even though the company reported a net loss per share of 15 cents, which technically missed the most conservative bottom-line expectations, the market chose to completely look past the near-term cash burn. The reason for this divergence between standard accounting losses and stock price appreciation lies in the underlying sequential expansion. Revenue was up over 18% compared to the previous sequential period, indicating that production output and commercial shipments are finally scaling to a level where fixed manufacturing costs can begin to be absorbed. This structural turn is what caught the short side of the market completely unprotected. Take a look at your own portfolio strategy and how you handle these rapid semiconductor shifts. Comment below how many shares of Navitas Semiconductor you currently hold, or if you were looking to manage this volatility through broader sector funds instead. It is interesting to see how this specific behavior contrasts with the broader macro environment. While large-scale indices are wrestling with broader interest rate anxieties and sticky inflation data, small-cap specialized components are trading purely on localized supply chains and raw sector momentum. If you look at the way tech assets are categorized within automated services like Schwab Intelligent Portfolios, the focus is typically on large-scale stability. But when a specialized firm starts capturing real market share in industrial power systems, it breaks out of those standard asset classes. The sudden re-rating of this stock from single digits earlier in the fiscal year to its current standing near the top of its 52-week range of $23.82 shows that sector momentum can completely decouple a stock from macroeconomic pressures if the underlying product demand is urgent enough.
To put this entire price movement into perspective, we have to look closely at what this business actually does and how its core operational model functions. The company operates as a pure-play developer of next-generation power semiconductors, specifically focusing on gallium nitride and silicon carbide technologies. For decades, the entire global tech landscape relied almost entirely on traditional silicon to manage electrical currents within power supplies, data centers, and consumer devices. The fundamental limitation of standard silicon is that it wastes a significant amount of energy as heat when switching at high speeds, which requires larger cooling systems and limits physical design efficiency. The business model here centers on designing proprietary integrated circuits that use these alternative materials, which can switch up to 20 times faster than legacy silicon and reduce energy losses by up to 50%. By supplying these components directly to hardware manufacturers, they allow consumer brands, electric vehicle producers, and data center operators to drastically shrink the size of their power hardware while increasing raw power delivery. Historically, the company relied heavily on mobile fast-charging blocks for consumer smartphones, supplying components to major brands across Asia and North America. This past performance created the long-standing market expectation that the company was merely a cyclical accessory supplier tied directly to smartphone upgrade frequencies. If smartphone sales slowed down, the common belief was that this component business would suffer structural decline. This is where the gap between old reports and current operational reality becomes highly visible. Over the past year, the operational focus has aggressively migrated toward high-power industrial applications. Data centers supporting heavy artificial intelligence workloads are currently facing unprecedented power grid constraints, requiring massive infrastructure overhauls to manage electrical distribution efficiently. By using gallium nitride circuits instead of old silicon configurations within data center power supplies, operators can pack significantly more computing power in the exact same physical server rack footprint. This industrial shift is an entirely different business model compared to selling cheap phone touchers, and it carries vastly superior pricing power and margin potential. When managing an individual brokerage account or analyzing assets through self-investing methods, evaluating these structural changes is what separates long-term viability from near-term hype. If you look at the options available on modern investing sites, or track standard index designs like Fidelity ETFs, specialized component companies are often buried beneath consumer electronics conglomerates. However, the commercial reality is that this business model requires deep capital investments in research and development, which explains the historical losses reflected on platforms like SoFi Invest or traditional Fidelity brokerage statements. The company operates primarily on a fabless manufacturing model, meaning they design the proprietary chip architectures and outsource the actual heavy chemical fabrication to major external foundries. This allows them to remain capital light regarding massive factory infrastructure, focusing their financial resources instead on engineering innovations and expanding their global patent portfolio. The older financial reports show a pattern of high cash utilization to secure foundry capacity, but the recent top-line beat indicates those capacity commitments are finally translating into commercial shipments. Looking toward the future outlook, the ongoing tension between market expectations and operational reality will continue to dictate where the stock moves next. The prevailing expectation among cautious Wall Street analysts, as seen in recent neutral notes from firms like Craig-Hallum or Rosenblatt, holding price targets well below the current spot market, is that the stock has run up too far too fast, creating a temporary bubble driven by localized short covering. They argue that the company still has to prove it can achieve sustained positive net income, and any delay in industrial or automotive customer rollouts could cause severe downside corrections. On the other side of that equation, the reality of the situation presents several powerful near-term catalysts. The rapid expansion of massive data center clusters globally represents an inelastic demand source for efficient power infrastructure. If the company secures additional direct Tier 1 design wins with major server manufacturers over the next 2 quarters, the revenue growth could easily outpace the conservative models held by traditional institutional analysts. Furthermore, the automotive sector represents a massive open variable for this specialized material technology. Electric vehicles require highly efficient onboard chargers and traction inverters to maximize driving range and minimize battery charging times. Silicon carbide and gallium nitride components are increasingly becoming the standard choice for next-generation vehicle platforms aiming for fast charging capabilities. The primary risk to this future outlook remains execution and supply chain stability. Because the company relies on third-party foundries to manufacture its proprietary designs, any localized geopolitical disruptions or capacity constraints at the foundry level could instantly choke off shipment volumes and harm key client relationships. Additionally, larger legacy semiconductor companies are not standing still. They are pouring significant resources into their own alternative material programs, meaning competitive pressures will inevitably intensify. For an investor utilizing online investing tools, tracking these specific design wins and monitoring foundry relationship disclosures will be absolutely critical to determining whether the company can sustain its current premium valuation, or if it will face a sharp retrenchment toward historical support levels. In summary, the central insights surrounding this specialized chip developer show a profound contrast between what the general market expected and what the real-time data is demonstrating. The stock market had long labeled this asset as a volatile consumer accessory play, bound to near-term losses and cyclical device trends. Yet the reality captured in the massive single-day closing price of $22.99 shows a fundamental structural pivot into high-value industrial infrastructure, high-power computing, and electric vehicle supply chains. The massive influx of institutional trading volume and the rapid unwinding of significant short positions have completely rewritten the technical and fundamental narrative on modern individual brokerage applications. While traditional analytical models remain cautious regarding immediate profitability and capital burn, the operational reality highlights a company sitting directly at a critical material bottleneck in modern tech design. Whether this rapid ascendancy can be sustained depends entirely on the long-term execution of their fabless production scaling and their ability to lock down long-term enterprise contracts before legacy giants catch up. The market narrative has been forced to shift, and the resulting price discovery has established a new, highly authoritative baseline for the future of power infrastructure analysis. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates.